Welcome, everyone, to the Information's TITV. My name is Akash Pastricha. It is Wednesday, January 28th. First up today, Amazon is laying off roughly 16,000 workers as it restructures. That news lands as we get the first quarterly results from the Mag 7. Microsoft and Meta report tonight. We will break it all down for you. We also have an exclusive story about Microsoft and how the company is responding to Anthropic's Claude Cowork. Next up, it is time for our e-commerce reporter to take a bow. Less than a month into the year, one of the Information's predictions has already come true. Amazon is shutting down its Amazon Fresh and Amazon Go grocery stores. We'll have a roundtable discussion on that. And we will wrap things with our weekly finance newsletter. Today's question, are SPACs making a comeback? We have got a lot to cover, so let's get right on into it. Amazon announced it is laying off another 16,000 people across the company as it looks to trim bureaucracy. This comes just a few months after Amazon said in October it was laying off 14,000 people. To help us break it all down, I want to bring on Josh Beck, Managing Director of AI and Internet Cloud at Raymond James. Josh, welcome to the show. It's great to have you here.
Thank you for having me on today.
So we had Amazon CEO Andy Jassy on the show actually just last week. Our editor-in-chief, Jessica Lesson, sat down with him, and we asked him about the layoffs that the company conducted in October. And I want to play the clip for you because I want to get your reaction to it right after.
Right now, I think that when we announced some role reductions, people assumed it was just AI because AI is kind of in the ethos of everything right now. And they just weren't AI. They were really about our culture. And for the longest time, I've been at Amazon 28 and a half years now. It has always been that we've hired...
I like how you're counting the half. I don't often get that, but it's really just ticking through. Yeah.
It's always been that we've hired really strong, ambitious, customer-focused people who were owners. And those owners got to own the two-way door decisions, which are the overwhelming majority of decisions that we make. And just what happens as you get bigger, I mean, we had very unusual growth in our retail business and our AWS business and what we were doing in ads. And so I think very understandably, we added a lot of people. And when you add a lot of people in a short period of time, you almost always choose to organize with a lot of different layers and managers. And it's kind of just makes it more digestible. But when you do so, you have unintended consequences, and some of which are that you end up taking ownership away from the owners. You've got the pre-meeting for the pre-meeting for the meeting. People don't show up with recommendations anymore because they know that the decision is going to get made 3 meetings later.
Yeah.
And that's not how we want to operate. We, as a leadership team, want to be the world's largest startup. And we are very convicted about that. And where we see layers stripping ownership, we're going to try and take those layers away. And we're going to try and flatten it. And we want our owners to be able to own. And so wherever we see obstacles to being able to move fast and have owners feel ownership, we're going to do so. And that has nothing to do with AI. Over time, there may be certain job functions where AI is really helping, where you change your allocation of people, but that hasn't been the case really today.
Mm-hmm.
So, Josh, that was, again, Andy Jassy last week in Davos. What did you make of the layoffs that they announced today and those comments that he made last week? I mean, are these just making up for overhiring? Is it because of AI? What do you think?
Yeah, I think it's a great question. I think there's certainly a huge expansion in the workforce, and it's just what I would say more operational pruning. I don't really view it as a dramatic response to one challenge or the other, but bigger picture. Amazon's business with respect to AI cloud all of a sudden is much more competitively intense than the traditional cloud. And at the same time, shopping, and particularly agentic shopping, you've seen a lot of announcements from Google, OpenAI, others, is also dramatically changing. So to me, to a little bit right the ship, kind of sharpen the organization as the competition is probably more intense than it has been for Amazon in the last decade, it is a smart move.
So you don't think this is necessarily to make room for all those investments in AI that the company is making, if I'm hearing you correctly?
They are certainly lagging. If you think about the metrics that we have around AI cloud, so that they mentioned they were at a multi-billion dollar run rate for Trainium. So I think that's the chips plus the revenue they're earning from Bedrock. But this is actually much smaller than what you would hear from Azure, from Google, Oracle, even CoreWeave. So they really have their work cut out for them. And that generally means you do need to invest and you need to focus, you need to shift your teams. This has been a theme really across tech. Certainly, you've seen Meta make big changes as well with respect to really sharpening their focus. So to me, it is creating the opportunity for them to invest, but it doesn't signal something kind of out of the ordinary in my view.
Do you think other tech companies follow suit?
I think it really depends. We've really judged all of these companies and written about them recently, particularly the mega cap companies, with respect to their AI stack. And what does it look like? There are AI native companies. I think we all know they are doing quite well with their AI stack. And then there are these large internet conglomerates that are having to make a big shift in their business, probably bigger than it was with mobile, and they are having to reallocate their priorities. So you're seeing this take place at Meta. I would say that Meta has their work cut out for them to really establish maybe not the dominant number one or number two position in the model evaluations and model benchmarks, but they need to be closer to the top. So they're certainly doing a reorganization. And Google had undergone something similar. Maybe it wasn't as high profile in the news, but did a large reorganization of their AI division and effectively gave the prior DeepMind CEO a lot more clout in bringing the product and commercial organizations together. So I think this is a trend within the mega cap tech. I think this is a big headline because it is such a big number. But in the grand scheme of Amazon, it's something like 1% of their total workforce, certainly much higher corporate wise. But I think this is a trend throughout mega cap tech.
And a trend that you think will keep coming, this will be a story in 2026. We will see these mega cap companies continue to lay off people.
In terms of future layoffs, so I think Google, for example, has done a very effective
Yeah.
reorganization. I
Right.
think estimates are really too low with respect to their top line. So I think they have the capacity to invest without some type of big restructuring. Amazon is more of the catch up position. We kind of have this AI framework of laggard, tweener, and darling. We put kind of Amazon in the tweener category, so I certainly think they're a company that needs to ensue some large changes and really kind of improve their positioning. I would say Meta is in the same spot as well. I don't really know that they need to do something dramatic because the top line of their business is in such a good spot.
Right.
Their returns on the ad stack have been great, and so I don't think this is indicative of some huge round of layoffs to come in the year ahead.
So we've got Meta and Microsoft reporting today. Let's start with Meta. As you said, the top line growth has historically been very strong. What are you watching for and listening for on the call tonight with Mark Zuckerberg?
So in my discussion with investors, I think the expectations for the top line are quite high. Checks with advertising, excuse me, with advertising agencies has been very upbeat. Certainly, the holiday season generally was viewed as outperforming expectations. So I think really the focus will be what type of investment are they making in the business in 2026. And we really think that the level of investment of total expenses is probably going to be higher than what the street is expecting. The street is something closer to 150 billion. We think that's much more likely to be the lower end of the guidance. So you'll see them take their expenses up. Same with respect to capex. The street is closer to 110 billion. I think that's very much a low end. So I think the message will be higher investment because they are more in this tweener catch up position. And what evidence can they provide that they're going to improve their positioning with respect to the model, with respect to monetization? And that's really what I think people will be most focused on. And there has been certainly big developments in the last week or even weekend about this idea of agentic AI and really tying it into messaging. Certainly, Meta has an incredible platform with respect to WhatsApp and Messenger. So maybe we'll hear a new line or two in terms of what that opportunity means to them.
Which feature are you referring to there exactly?
There's been a number of developments that I think has generally made the attitude around agentic, particularly this personal AI assistant idea. So originally it was called Claudebot, and there's a rename to Moltbot. So this idea of a assistant that that can find you where you are within your messaging apps, go act on your behalf. Certainly, that it's something of a demo, I would say at this point. But this idea of an agent acting on your behalf, I think, is a powerful one, and Meta does have a really good platform to distribute a product like this.
Right. Very quickly, so we've also got Microsoft. Microsoft, we're obviously going to be watching the Azure growth rate. Other than that, what is the one number that you're going to be paying most attention to tonight?
So on our side, Andrew Merrick covers Microsoft,
Okay.
and
Okay.
I think his view is he's pretty optimistic on the Azure business. I
Right.
think there's a lot of focus on Copilot and whether it's really kind of gaining traction or not.
And what about Google? You upgraded the stock recently. What are you watching for there when they do report?
Yeah, so for Google, there's really two elements of the upgrade. So one is I think the search estimates are too low for 26 and 27. We think they're much more likely to be in the low teens. The street has that business decelerating to the high single digit rate. The primary reason for our optimism is we think the mix of AI overview and AI mode clicks is likely to go up pretty substantially. Those are much more valuable clicks. They have much higher conversion. So the cost per click, we think, will actually be a much bigger driver of growth than the street is expecting. So we think the narrative on search is likely to prove, and very similar with the cloud business. We actually think it can grow mid 40s next year, or sorry, in 2026. The street is at mid 30s. The primary reason is we think adoption of TPUs is really starting to ramp up. This has become a very popular inference type of chip and workload. And then we also think the momentum with Gemini API is also picking up. So we really think the momentum at Google Cloud is likely to be better than anticipated. And so when investors look at these stocks, if you are accelerating, then I certainly think it means you are becoming a winner or beneficiary in the AI race, and you can see multiple expansion in those scenarios.
Great. Well, Josh, I want to thank you for coming on. That is Josh Beck from Raymond James here on TI TV.
Thank you.
Okay. Anthropic has been making headlines with its Claude Cowork tool, as we just talked about, that has engrossed Silicon Valley. Microsoft is among the companies that has paid close attention, and my colleague Aaron Holmes today published a story on how the company is responding. I want to bring on Aaron to talk all about it. Aaron, welcome to the show. It's great to have you here.
Happy to be here.
How is Microsoft responding to Claude Cowork?
Yeah, so I mean, basically, ever since this product was, unveiled by Anthropic a couple of years ago, it has basically sent ripples throughout Microsoft's technical ranks. There have been a flurry of memos being passed around about how Microsoft can respond, and CEO Satya Nadella himself has been encouraging people to, use this as inspiration to make Microsoft 365 Copilot, which is their AI product in Office, work even better. And essentially, I think what is so compelling about Cowork is that it can carry out a lot of tasks kind of across applications and across even a user's desktop, which unlocks a lot of use cases that might not be possible with other out-of-the-box AI products. And I think that's something that everyone at Microsoft has been paying close attention to.
So Cowork is one tool that obviously people have been talking about. The other tool is Claudebot. This other tool has come up. It's now called Moltbot. We now know they changed their name this week. What exactly is Moltbot, and why has that been getting so much attention?
Yeah, so similar to Cowork, which relies on Anthropic's Claude Code models, Moltbot is a basically an open source project that is a framework that calls the Anthropic models, which of course are not open source. And it essentially, similar to Cowork, lives on a single computer and is able to use the computer in a way that a human would. It can see the screen, it can move the mouse around and carry out tasks. And so we've seen like a flurry of people experimenting with it and basically using it to carry out tasks like pointing it at a photo album full of receipts and saying, make this into an Excel spreadsheet with all of my expenses listed in a consistent format. And I actually heard that Microsoft CEO Satya Nadella has been playing around with Claudebot over this past weekend and was sending some of his findings to his deputies and saying, why can't we think of ways for Microsoft to build similar products to this?
And just so I understand this, so I'm calling it Moltbot. You can call it Claudebot, whatever. We know we're talking about the same thing, but is Claude Cowork and Moltbot, are they sort of competitive products? Are they sort of like doing the same thing for people?
Yeah, so I mean, they both rely on Anthropic's models. Cowork is something that Anthropic put out formally in a preview, and Moltbot is more of a, I guess, fan project that still relies on those models, but they essentially do similar things. I think in both cases, they're pretty nascent in that it's not exactly clear if they're ready for like an enterprise deployment, and Anthropic has warned people not to use Cowork on risky projects or anything that involves sensitive data just because there's a lot of risks that haven't been ironed out yet. So in that regard, it's not exactly the same as the enterprise ready products that Microsoft is selling, but I think it's nonetheless, pretty inspiring to the folks who are building competing products.
So now you talked about how Satya Nadella has been paying attention to both of these product rollouts. Conceivably, he's probably thinking about how Microsoft can respond, maybe with its own pilot. You talked about Copilot maybe as being one avenue or one lever they could pull. How much of an advantage does Microsoft have, given that a lot of the programs like Excel, Word, etc., I mean, Microsoft owns that stack. They run it. Is there an advantage there, and could it ultimately give it a leg up, even if it's late to the game?
Yeah, I mean, the fact that Microsoft has this suite of apps that people already use to do work is definitely an advantage and gives them, a feedback loop to keep improving new AI features in it. And I think another big advantage is that they own Windows. And right now, Cowork from Anthropic can only run on Mac. I think that from what I've heard, Microsoft leaders think that having Windows as their home turf could help them get a leg up on similar features that use the Windows operating system and, could make it more easy to build native products that do things like organize your files or, put together documents based on various sources of information. So that's definitely, I think, one potential advantage that we see Microsoft having.
And then the other thing that I've been thinking about is how Microsoft is sort of hedged on this play all around, given that they are investors in Anthropic. Anthropic is also a customer of Microsoft, which probably, I mean, this is all cloud use that they need to buy essentially to run all these programs. So it seems kind of like a win-win in some ways.
Yeah, I mean, I think this is kind of a theme throughout the AI boom that we've seen is there's this like constant shifting landscape of who is friends with other companies and who's competing. And often, there's these situations where there's friendly competition between companies who are big customers of each other and are also building new products that go head to head, trying to win the same customers. And Microsoft has definitely leaned into that by, investing in Anthropic after investing in OpenAI and also being, a big user of models of both of those startups.
Very quickly before you go, so we've got Microsoft reporting tonight their quarterly results. We know that Azure growth is going to be something that everyone watches. It's a number everyone pays attention to. What what clarity are you hoping to get a little bit more of from Satya Nadella's comments on the call tonight?
Yeah, I mean, I think everyone is continuing to see how much AI will uplift Azure. I think it's also going to be important to see how much remaining obligations they have in Azure, which have grown a lot just due to the fact that there's, this backlog on GPUs being available. And I think a lot of people are also looking for, any sort of evidence of how many customers are paying for 365 Copilot. Microsoft hasn't yet shared a specific number of paid 365 Copilot seats. And so, if they do that, I think that would definitely be notable.
Great. Well, Aaron, I want to thank you for coming on. That is Aaron Holmes, our Microsoft reporter here at The Information. Okay, Amazon is shutting down its Amazon Fresh and Amazon Go grocery stores, ending what has been a long and winding saga for those franchises. That was actually one of our e-commerce reporter Ann Guillen's predictions for the company in 2026, which she made just a few weeks ago. It's crazy to think how quickly things happen sometimes. I want to bring on Ann to help us break it all down. And I also want to bring on Theo Waite, our reporter who previously has done a ton of reporting on Amazon's grocery journey. Ann and Theo, welcome to you both. It's great to have you both here.
Hi, Akash.
Good to be here.
And what was the reason that Amazon gave this week for why it's shutting down these stores?
Yeah, so when they made the announcement this week, Amazon said that both the Fresh stores, which are grocery stores, and then their Amazon Go convenience stores, which they're also closing, they said that they're pulling out of those projects because they couldn't provide a distinctive customer experience. And that's actually an idea that Jeff Bezos mapped out the first time that Amazon thought about getting into brick and mortar retail, which was about a decade ago. They opened some bookstores in the Seattle area. So that's always kind of been like the overarching thought for Amazon's brick and mortar strategy, is trying to do kind of a more distinctive, sometimes more high tech customer experience.
And so he's saying that they're saying the customer experience is not where they want it to be. What was it about the state of the stores that made you make this prediction a couple weeks ago that they were going to shutter it entirely?
Yeah, well, I'm sure Theo can walk you through some of his previous reporting, but the grocery business was really, really important for Amazon last year. And it was something that executives were talking about constantly, saying how important it was for their business. It's part of a big push to increase how frequently people are shopping on Amazon. The CEO of their retail business, Doug Harrington, has an extensive background in the grocery business. And so they expanded both Whole Foods and their online grocery delivery services fairly aggressively last year. But during this big grocery push, we never really heard much about Fresh. And as Theo has reported, there have been a lot of twists and turns in what the Fresh concept entails exactly. And there just have always been some signals that Amazon didn't really have like a super clear vision or strategy for where Fresh fit into their grocery business. So I think all the signs were there, and especially just given that Amazon has been on kind of a broader cost cutting and corporate efficiency push over the last year, as we've seen with the layoffs recently. Just kind of all the signs were there to me that Fresh, it was maybe time for Amazon to cut their losses and work on some other projects when it comes to grocery.
Theo, you did a ton of reporting on this when you covered Amazon. You, of course, cover all things Elon Musk now, but I want to ask you about some of the stories that you wrote. And before we do it, I just want to remind myself. So, Amazon Fresh, which one of these concepts was the one where you just walk in and walk out? Was that the Amazon Go?
They both had that
Okay.
technology. It was an Amazon Go first, which
Okay, it was
is
Amazon Go Fresh. And so the difference between Fresh and Go was what?
Fresh was bigger.
Fresh was bigger. Okay.
Generally more of like a full grocery store, and Go was a convenience store. But it's totally fine to be confused because they also had something called Go Grocery, which was a somewhere in between. They never really figured out the branding. It was totally confusing.
I was just saying earlier that to our producer that Fresh and Go sounds like a grocery store on its own. I mean, you could be forgiven for not thinking that is the name of the store on its own. So you did a ton of reporting on this, and as Anne described, it seems like this was sort of a slow death. There were signs of this. Talk a little bit about what you found over the course of the couple years that you covered the company.
Yeah, I mean, it's kind of been this troubled project ever since I started covering Amazon, honestly. Like one of the first stories I did in 2022 was around the time that Amazon started doing its first major corporate layoffs in its history. I drove around New Jersey and found all these Amazon Fresh stores that had been built but weren't actually opening, and they kind of had the lights on and had all this expensive technology in them, but were just sitting there. Um, and that kind of like symbolized the approach to the whole program, where Amazon, had all these plans for hundreds of stores or thousands of stores. They were going to open them in Europe. They were going to do all this really advanced technology in all of them, and instead they weren't really willing to ever like fully pull the trigger and completely expand, but they also weren't willing to pull the plug until recently. But when you think about the company's motivation for getting into physical stores, like it makes sense, right? Because Amazon's a company that wants to interact with every consumer in every possible way. And when you as a person are sitting at home and want to buy something, like Amazon comes to mind no matter what the product is, whether it's like eggs or a TV or something. And you kind of need physical stores to reach people when they're thinking about groceries. But the problem is like the stores really just like, I guess, do you as a consumer, do you go to a grocery store to buy groceries or to like look at fancy new technology?
I go
Because
to buy groceries.
because I go to buy groceries, and the
I have the
problem with
same 7
Amazon
things
Fresh,
over and over again.
yeah, and the problem with Amazon Fresh was that you go to the store and it feels like a tech demo that also has like groceries as a component of it. But primarily, like, there are these cameras and there's lights and there's everything feels designed around technology, and it's very strange, and they never
But
really.
okay, so let's just talk about this. So, and Theo, you spent a lot of time studying this. So, Anne, you mentioned that the company sort of said that it didn't have a distinct customer experience, which, yeah, fine. How do you make it distinct in a grocery store? I guess you walk in, walk out, to the extent you don't have to wait in line. Maybe that's the big time saving there. But I'm just trying to figure out, why the execute was this was this a strategy issue? Was it an execution issue? I mean, it feels like setting up a grocery store, and by the way, they have Whole Foods too, right? I mean, I don't know. I'm just trying to figure out why it didn't work.
It was because they had a technology, and then they tried to design a store to go around the technology,
Got it.
in my opinion. And that makes it a distinctive experience, but it doesn't mean that it was actually good.
Right.
Like, I think that was the problem.
Right. And now, if you think about the breadth of Amazon's business, it has all these other businesses: cloud, video, the marketplace, obviously. I mean, this doesn't seem like a huge impact, I guess, for the company financially. I mean, this was sort of like a side project in some ways, right?
Yeah, I mean, like I said, the fresh concept has existed in some form for pretty much 5 whole years at this point. So I think, 5 years is definitely more than enough time for Amazon to cut their losses. And yeah, it probably won't be a major hit to their business in the grand scheme of things. They actually said yesterday when they made the announcement that some of the store locations will be turned into Whole Foods stores. So they're not, totally giving up on brick and mortar when it comes to grocery. I've also done some reporting that they're in the early stages of a new kind of big box super center concept that would be more similar to like a Walmart or a Target. They're working on that project in the Chicago suburbs right now. So I think, in terms of fresh, it's not, super significant for Amazon's business, but I think all the steps that Amazon has been taking more broadly over the last year or so, it does underscore how critical grocery is to their retail business. And they do need to get grocery right eventually in order for the retail business to continue growing. And so I think they feel confident about the direction of Whole Foods. They've been opening some new smaller Whole Foods stores, mostly in cities. They've also been working on a new rapid 30-minute delivery for groceries and other kind of like daily household products. So Amazon's clearly still willing to experiment with this, but I think they will need to eventually land on a grocery solution that works in order for their retail business to continue growing.
And Theo, I'm going to give you the final word because I know that you are the most passionate about Amazon Fresh and Amazon Go in our newsroom. And what lessons do you think Amazon is pulling out of this as it looks ahead to building out its physical storefront presence?
I, I would say that focusing on Whole Foods makes sense. I think they finally discovered what everyone else already knew, which is that Whole Foods was a better place to shop than Amazon Fresh. And I think they also say they're going to focus a lot on delivery, which makes sense, and because that's what they're actually good at.
Right. Great. Well, Theo and Ann, I want to thank you for coming on. That is Ann Guillen, our e-commerce reporter, and Theo Waite, our Elon Musk, formerly our Amazon reporter here at The Information. Okay. Are SPACs back? That is the topic of this week's finance newsletter. The Information's finance editor, Ken Brown, looks at some recent companies that are charging towards the public markets with this once upon a time, very popular and yet very alternative route to listing shares. I want to bring on Ken to tell us more about what he's seeing. Ken, welcome back to the show. It's great to have you here.
Hi, Akash.
You and I are both here in San Francisco this
No,
week.
I see you across the room.
I know. You're just over there, actually. Okay. So you wrote this column and you started off by talking about General Fusion, which is a company that we had on the show when they made news and saying that, hey, we're going to go public
Right.
via a SPAC. I was talking to you before having General Fusion on the show, and we were talking about what stood out to us about this deal. What was it for you that really piqued your curiosity here?
Well, so it was two things. One is there are no fusion companies in the public markets because fusion is so far in the future and so speculative that most people don't want to put money into it, right? I mean, the best case scenario is 10 years. The second thing was it fit with what I had been observing in the SPAC market, which is the market was supposed to have been reformed, changed after the big bubble because so much money was lost after 2020 and 2021 by investors who had invested in SPACs. And the rules had changed, but what General Fusion shows and other companies show is the rule changes really have had no impact.
When you say they had no impact, would you give us a bit of the history here on what exactly companies were leveraging in this SPAC boom and then what the rule change was?
Exactly. So when you have an IPO, which is the classic way to go public, you are very restricted on what you can basically promise to investors. You can't say we're going to grow 90% a year for the next decade or whatever. You just can't say those kind of things. With SPACs, there were no rules about that. And so people were making all these crazy claims and investors were buying it and the stocks went up and then the stocks went down. And so the rules came in and says you can't do that anymore. It has to be more like IPOs. But with a lot of these companies, and General Fusion is not doing anything wrong because the reality of their business is it's a 10-year time horizon. But when they come out and say, we're going to do fusion, and they also talk about the steps they're going to take, we're going to do fusion, it's 10 years away. So no regulator is going to come back to General Fusion in 2035 and say, or 2036 and say, you didn't meet your expectations that you told investors what they were doing in 2026. So because of the long time horizons, people can kind of say what they want and these speculative stocks can still come out. And so, yeah, the rules were changed and regulators might be on top of some companies that do make more short-term change, promises. But that was my point. That really, like, a lot has not changed.
But help me understand. I just want to make sure that I understand the difference here between making a growth estimate in, well, companies give guidance, right? I mean, you come up with quarterly
Sure.
results, you can give guidance that is somewhat forward looking. It's not a guarantee. What is the difference between that and then the growth forecast? I guess the long term projections that these companies were making when they were doing SPACs.
Well, if you remember some of these specs, we're going to have space tourism. We're going to sell 1 million cars a year. There was stuff that was like much more short term. And so that was part of the issue, is that they were making these big claims
Got it.
in the short term. Um, yeah, companies can always talk about the quarter ahead, but like these were beyond that. These were big claims about we're going to do stuff that no one's ever done before in a relatively short time period. So
Hmm.
there was stuff that in the IPO rules you never could have said, and so you never could have hyped a stock like space tourism kind of stuff. You couldn't have hyped it like that, and so the rules are supposed to change that. And my argument is, at least with some of the stocks that are out there, they haven't.
And why do you think that's the case? Why haven't the rules worked the way they were designed to?
Well, because I think the companies, at least a lot of them that we're seeing now, so there's quantum computing, there's these crypto banks, there's other stuff like that. They're so speculative. Their future gains are so far out in the future that the rules really, they're not going to be able to apply them. If you promise something, dramatic in the next year, or you promise to transform the world in the next year, yeah, you could get caught out. The other issue is that, and this is just a common thing with under the Trump administration, there's not been a lot of enforcement, and
Hmm.
so everybody knows in the finance industry that you can push the limits of things, and because there's been very little enforcement of these rules or any rules, which is why we're seeing so much crypto and so much all this stuff, and so that's just also the context, and so I think the two add up to here we are again, in another. It's a mini boom. It's nothing like the boom we had few years ago, but they're back. The volume is back up to, higher than it's been in any other year, but the boom period.
And you also wrote that, I mean, amidst all this talk about whether we're in a bubble or not, how much of that is AI, et cetera. I mean, this is really a signal of frothy times in the market.
Exactly, exactly. And it's also, I mean, from where I'm trying to write is like these things are geared towards hot industries that individual investors might get excited about. And so I kind of just want to warn them or remind them that like individual investors really got slammed the last time. And, the people who do the SPACs tend to make money, and the early investors tend to make money, but not the individuals. So, there is speculation and, put a little warning sign out there.
And last question for you, because I just want to understand some of the lines here, to the
Mhm.
extent that there are lines at all being drawn between, what is guidance, what is a crazy far off projection. I mean, I'm thinking about what Elon Musk says, on podcasts, on on earnings calls. I mean, Elon Musk is also he's making these sort of big claims about how many millions of robo taxis they're going to sell, et cetera. Is how does that square with what these companies going public via SPAC say?
Well, he's kind of a special case. He kind of wants. He's tangled with the SEC on these issues. There's no regular. The SEC is not doing anything now. So, or at least not doing anything with him. Yeah, I mean, people push the limits, and yeah, he's unique. I mean, look, I'm talking about most companies.
Yeah.
Most companies that run the way most companies do, and they don't do this stuff. He's he's the special. He's a special case.
Special
We're gonna
case.
have robots, we're gonna have robo taxis, we're gonna have flying cars, whatever, yeah. The other question is, I mean, and I think investors do take him seriously. I mean, if you look at Tesla, the business is terrible and the valuation is super high, and I think it's because, of what people think in the future.
Yeah. Great. Well, Ken, I want to thank you for coming on. It was a great column, and I encourage everyone to read it. That is Ken Brown, our finance editor here at The Information. Well, that does it for today's show. A reminder, we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. I want to thank you all for joining us. We really do appreciate your viewership. I am already excited for our next show tomorrow. Have a great rest of your Wednesday. Bye-bye for now.